All right, I got breaking news for everybody. Washington State's DCP has finally announced a start date for the Roth DCP plan. According to a recent article they just published, everyone's going to start being allowed to make Roth DCP contributions starting October 1st, 2023. And yes, they are allowing Roth conversions. Let me show you the document as I walk you through it and give you some insight onto all the different rules and regulations about how they're going to implement this and some things you need to be aware about before diving into it. All right, so you can see on my screen here, this was just released sometime earlier this month in February. This is February 6th as the date of this recording. So sometime in the last few days, they just announced this. So you can see right here, big bold letters, Roth is starting October 1st, 2023. And they are allowing you guys to convert existing pre-tax contributions to the Roth option. That means if you currently have money inside of the DCP that is pre-tax, you can move it over to the Roth side. You are going to have to pay taxes on this. So this is a huge tax plan opportunity for everybody that you can actually start doing this year. So this is a big opportunity for you guys to miss out on. Oftentimes we have to wait for our clients to be retired before we can do this kind of opportunity with them. With this announcement, this means that we can start doing a lot more tax plan for our clients a lot earlier, which means more long-term tax savings goals. Of course, you want to make sure you're working with a qualified person when you're doing this, because this is taxes. You do it wrong, it can kind of mess things up, affect your other benefits. So this is something that you should really have some guidance on, especially at least the first time around, to make sure you're getting everything implemented correctly. Also remember, this is also DCP's first time around. So there can and probably will be errors made as they have to train staff on how to do Roth contributions for all the employers. People inside of the department also have to be familiar with Roth now. And then when they send out their tax forms, we got to make sure double check the numbers that they're reporting it correctly. Because I've seen some other employers that have Roth options do this and they report the wrong numbers on the tax form. Good thing is if you can catch it ahead of time, it's not a big deal. But when we catch it late and the IRS catches it, then you get one of those angry letters in the mail. So it's best to work with somebody and make sure all these things get implemented correctly. All right, let's keep going here. I'll post this in the description as well, in case you guys want to read it yourself. They kind of go over what Roth is, which if you follow the channel, you already know. It is going to be required for all employers. So no employer has the right to say, no, we're not doing Roth. Everybody that offers DCP has to do Roth. All school districts, all cities, everybody's included in this. They actually aren't even planning to announce this till mid-2023 is when they're going to start announcing to the public. If you follow the channel, now you guys know a few months ahead of time. Let's see. So as far as the contributions go from the employer, they're still going to be pre-tax. So you're going to be able to do Roth contributions. You're going to pay taxes on your contributions now. Your employer contributions are still pre-tax. So even if you put all of your contributions for Roth, you convert all to Roth, every time your employer makes contribution, that's still a pre-tax portion that you're going to have to convert into Roth or do whatever, pay taxes on eventually down the road. So just know that there's always going to be a sliver in your account that's still going to be pre-tax, just because that's how the employers are still putting money into the system. This one here just says the employer cannot split contributions, so the employer has to do pre-tax. However, you as the employee can split your contributions. So you can put money in the pre-tax side, or you can put money in the Roth side, or both. You just have to stay within the IRS limits. Remember, the limits change each year, but we just can't do more than what the limit said, regardless of what side we go on. So if the limit says 30,000 for the year, we can't do 30,000 Roth and 30,000 pre-tax, right? That's over the limits. We have to stay within 30. How you want to split that up, it's up to you. You want to go 10,000 pre-tax, 20,000 Roth, or vice versa, completely fine. It's up to you guys to notify them if you want to do Roth or not. So you have to go to your online system to report your contributions. You have to change it from pre-tax to Roth. It's not something that's going to happen automatically. So if you want to do Roth, you have to make sure you go into the system and tell your employer, yes, I want to do Roth. See, DCP has a limit. So the limit is at least $30, and it's $30 per side. So if you're like, I just want to start off the DCP with a little bit, it's $30 to get started. But you have to pick pre-tax or Roth. You can't split that amount. The minimum you can do if you were trying to split between pre-tax and Roths is $30 a piece. You can also have the option to elect percentages if you want, and the percentages don't have to be equal. So if you want to do 1% Roth, 3% pre-tax, you can do that. You have the right to change that anytime you want to. The thing around DCP is it can take actually up to 30 days for those kind of changes to be implemented. And it says so right here. may take up to 30 days. And that's actually one of the biggest complaints I've had from people that are currently in the DCP plan, is that they go in there to make a contribution change and it doesn't happen. And it takes a while for it to go through the system. So they're still kind of slow to implement it. So if they're slow to implement your contribution changes, they might be a bit slower doing your Roth conversions. So it's a good idea. If you're thinking of doing a conversion, you want to start looking at this in October. Don't wait till November, December, because it may not get done in time. And if you want it to count for 2023, it needs to be done before the end of the year. And then they have one here. How is the DCP Roth different from a Roth IRA? Great question. I'll probably make a future video on this one here. They say the main difference is the income limits, right? So Roth IRA has income limits, DCP does not. DCP has a higher contribution limit. Yeah, so that's all right. But of course, it's a generic response. So to dig into it a little bit, you want to know that the other advantage is Roth IRAs individual retirement account, which means you can set it up as an individual, which means you have free and clear to choose whatever investments you want. You want to invest in individual stocks, index, mutual funds, you pick any one of them that you want. You want to buy Bitcoin or any kind of crypto in Roth, you can do that too. In the DCP ran by Washington State Investment Board, you can only use their funds. They have 7 funds to choose from, and that's it. So you're very, very limited in terms of investment selection. And what that means is it's really hard to build a really good diverse portfolio with 7 funds. Most of my clients' portfolios have anywhere from 20 to 40 different investments in there, because we want to pick and choose, different industries and categories from around the world, where in DCP, you just can't get that level of diversification in there. The other thing they're not really mentioning here is the idea of Roth, right? Roth, if you're not familiar with it, just means I put money in and then it grows tax-free and I can withdraw it tax-free. That's all true, but you have to meet what they call a 5-year rule. So the 5-year rule means from the time I make my first Roth contribution, whether that be a Roth IRA or the Roth DCP in this case, from the time I make my first contribution, I have to wait at least 5 calendar years before the growth is considered tax-free. Now, anytime you can get your contributions out without paying taxes on it because you already paid taxes on it ahead of time. It's just that the growth has stayed there for at least 5 years. Now, both these have the 5-year rule in them. So if you're going to do the DCP Roth and then you're going to retire next year, just know that any growth that you had in that DCP Roth still isn't technically tax-free yet. You have to wait 5 years for that to be true. Other thing to consider here is if you're going to move money from Roth DCP to Roth IRA, if the Roth IRA is not 5 years old, you might reset your account. So if you had a Roth DCP account, let's say you had it for 10 years, and then you're like, hey, I'm going to move to Roth IRA, you open up a Roth IRA and just move your DCP into it, because the Roth IRA is only brand new, you just opened it, you basically reset the 5-year rule. Now you gotta wait another 5 years for the growth in that account to be considered tax-free. So like I said, dealing with Roth stuff, there's a bunch of different rules and they always change. So it's good to have an advisor you're working with before you start making these kind of moves on your own. All right, so continuing on here, how is the Roth percentage collected? So they're gonna take it off your gross pay. So remember that Roth, you're paying tax on, so there's no tax deduction. So previously, if you're making, $5,000 a month, you do 1,000 DCP, you'd see that deduction, then only 4,000 be subject to taxes. If you do 1,000 to the Roth, they're gonna, base or you do a percentage off the Roth, they'll base off the gross, but you're still gonna pay taxes on the entire 5,000 if that was the case. So remember, it does not lower your taxable income here. And they're gonna, like I said, they're basing the percentage off of the gross pay. So if you're going to do, 10% of your $5,000 salary, it's going to be $500. So they're not going to take taxes and then do 10% of the remaining amount. That should just be too complicated for everybody. It also says there are no exemptions for emergencies. Yeah, so the IRS rules are pretty black and white. If you don't have the 5-year rule, you're paying taxes on the money that comes out of the Roth. So this rule right here, it says, when does the 5-year rule begin? They're saying that it's on your contribution date. That's actually not true. When we do a Roth contribution or Roth conversion, we go by tax years, not by the date that the contribution or conversion actually went through. So what that means is if you do a contribution on, say, October 31st of this year in 2023, by their definition, you have to wait 5 years. So you have to wait until October 31st of 2028 for the 5-year rule to be satisfied. However, the truth is, when you make a contribution, regardless of when it is, it counts as you doing it on January 1st of that year. So you make a contribution in October of 2023 or November or wherever, as long as it's done before the end of the year, they're going to use January 1st as the actual contribution date. So this means that your 5-year old is going to be satisfied on January 1st of 2028, not on October or whatever date you actually did it. So that's a kind of a big oversight that they did there. So just know that what they're saying here is not true, and hopefully they correct that in the future. The first time you make your contribution, that's what starts the clock. So if you're trying to go from Roth DCP to Roth IRA, remember that you can't just open up a Roth IRA and let it sit there empty for 5 years. You got to make contributions. That's what starts the clock, is the contribution. Now, remember, you can only do contributions if you're under a certain income limit. If you're over it, you might have to use a backdoor Roth strategy. That's a topic on its own. And if you need help with that, we can always book a consultation. We'll go through that more in detail, because there's a lot of caveats on how to implement that strategy correctly. All right, to convert to pre-tax to Roth option, you can contact DCP record keeper or complete a conversion request form. All right, yeah, so there's going to be paperwork that needs to be signed to do this. Like I said, you want to turn this in early to make sure it gets done correctly, because even outside of this, when I'm doing Roth conversion for clients in their IRAs with large institutions, it can still take a couple of weeks to get things through the system to get bogged down. So you don't want to wait too long before requesting this kind of thing. If I take a Roth withdrawal and a pre-tax withdrawal, we'll actually have 1 or 2 1099s. They're saying you get 2 separate 1099s. One's going to show you how much your total tax is on. The Roth one, remember that when you take a Roth withdrawal, you still get a tax return to it. Even if you don't owe any taxes on it, they're still going to show how much money came out of that account. The key is just to look for a taxable amount in the 1099s. It should say 0, right? I owe no taxes because I already paid it all. But that income still does get reported to the IRS. Doesn't really affect your benefits because it's not considered taxable income, but nonetheless, it does get reported. And how does Roth get reported on taxes? Remember, the Roth is a long-term play, so it's not going to immediately impact your taxes today. So you can do, $10 to Roth, 100, 1,000, $10,000 to Roth. It does absolutely nothing to your taxes today. But what it does is grow tax free for the future. And here's a good question here. Can I use Roth balance to purchase annuity? They're saying no, right? So that actually wouldn't be a bad idea. If I put Roth into it, then I could get lifetime income that's tax free. They're saying you can't. It has to be a taxable money going in. So one reason why you may not want to convert to a DCP plan is if you're considering using one of the annuities or purchasing service credits with money from DCP. It sounds like they're not going to take Roth money here. So one reason maybe hold off is if you plan on buying a PERS, TERS, or even the service credit annuity from DRS. All right, next question. Can I choose different investment options for Roth and pre-tax if I contribute to both? Let's see, they're saying with DCP, you need to select the same investment options for both Roth and pre-tax. After you've enrolled, you can select different investment options for investments for your Roth pre-tax. Okay. So when you first enroll, they have to be set up the same. Once the money is split up in there, you can then have different allocations. So you can invest your pre-tax account differently from your Roth. The reason that's important is because Roth grows tax-free. Typically, it makes the most sense to hold your more aggressive assets on the Roth side of things. So instead of looking at this as 2 separate accounts, think of it just in 2 different parts, right? So if I'm going to have my portfolio set up, 60% equities, 40% bonds, the classic 60-40 thing, it would probably make more sense to put 60% of it, if you could, right, into the Roth side, or have the Roth hold more aggressive assets, because as that's more likely to grow, right, that growth is going to be tax-free, where bonds, they grow a little bit, but not a lot. Remember that we have to owe taxes on all the growth again on our pre-tax side. So typically, we want to hold the more conservative assets on the pre-tax side so it doesn't grow as fast, therefore mitigating any kind of long-term tax bill. And by putting equities in the Roth side, you can maximize your tax-free earnings. And then can I change my mind and have designated Roth contribution treated as pre-tax? No. Yeah, so there's no takebacks. So once you make the contribution, that's done. Same goes for your conversion. Once you say, hey, I want you to move this money from pre-tax to the Roth side of DCP, that's it. There's no way to take that back once you've put that paperwork through, right? So if later down the road you found out that now you owe more taxes than you realize, that might be that's going to be a problem, but you can't go back and undo it. As far as the auto hire, so if your employer automatically enrolls people inside DCP, it's going to go pre-tax. That's kind of industry standard. But you can always change it anytime to go to Roth or whatnot and convert as you see fit. Can I roll a Roth balance if I change employment? Yeah. So you're gonna be able to move your Roth money from the DCP to Roth IRA or another Roth 401k or what have you. So it can be, money can be rolled out. They also set Roth rollovers in. So if you had like a Roth 403b you no longer wanted, you could technically roll that in to the DCP account. You would, of course, lose access to the investment options, the loan provisions, but you could do it. You could roll Roth IRAs into it, but you would essentially forfeit the 5-year rule we went over. So I don't know if that would be in their best interest, but it is an option. All right, so that's the announcement for today. I'll keep you guys updated as more information comes out. Any questions on this, drop them in the comments below. I'll catch you guys all later. Remember that your future depends what you do today.